What is going on, Future Focus Nation? My name is George and I make videos to help you make money investing. Today, I'm going to be giving you 7 reasons why some of your favorite stocks, such as MP Materials, HYLN, PLTR, and other companies that are actually good, actually making money, have a great product, are doing bad and they've been getting slayed lately. The reason I'm making this video is that the go-to reason for why stocks are going down is always fear. They always say, there's fear in the market and that's why stocks are going down. And while that is sometimes true, there are other reasons, more macroeconomic reasons, why stocks are going down. So today I'm going to be giving you 7 of those reasons. Before we get into that, I wanted to let you know that I created a Discord for the channel. And if you're into finances and investing, whether it be real estate, precious metals, cryptocurrency, stocks, I created individual chats for different levels of investing. And if you're interested in that, if you're on Discord, join us. We're still small, but the goal is to grow and learn from each other. If you're interested in joining, it's free. And the link is in the description below. But with all that said, let's jump right into it. Reason number 1 is supply and demand. There are so many different things out there that are hot right now, such as real estate, the stock market, cryptocurrency. But even with all this unemployment money and stimulus checks and the economy opening back up, there is only so much liquidity to spread around to these individual assets. Even within the stock market itself, there are a bunch of different companies that look attractive. However, we can't put our money into every single one of those. One of these sectors that's getting hit harder than a lot of other ones is the SPACs. Since 2020, there have been 549 different SPACs that have priced in. Out of those 549, there are a lot that haven't merged yet, and there are 134 that are below $10 and have no target or anybody that they're going to merge with. They're just a pile of money sitting on the stock market. The attractiveness of SPACs is that it sort of makes you feel like a Shark Tank investor, where you're like getting in before the stock actually IPOs. So you feel like you're getting into it on the ground floor. And some SPACs have done well and some other SPACs have done horrible. An example of one that's done really well is DraftKings. But an example of one that's done really horrible is Nikola. So before the crash last year, a blank check firm shares surged on Nikola's merger news. This is when they announced that they were going to be merging with Nikola. And people got excited about it because they started speculating that this was going to be the next Tesla. So around June timeframe, Nikola started trading after the reverse merger. And right away, the stock jumped up all the way to like $80 a share. But then little by little, the stock's been going down. And every so often, you could see here, this is something called a bull trap. Is when it gives you an impression that the stock's going to start trading in the right direction again, and people start getting confidence and they start investing in it, only to have the stock drop. So you can see that that's happened on multiple occasions. Now, a year later, the stock is actually lower than it was before the merger was announced. Now, here's another company, Coinbase. They IPO'd at about $385 a share, and they closed that day at about $400. And yes, it dropped, but just look at the way it started. In order for a company with a market cap this big, it takes a lot of money to move this stock. And again, that money has to come out of somewhere. There are a lot of retail investors that had to sell out of other stocks, not because they were afraid, but because they wanted to get in on Coinbase. They felt like Coinbase was another way to play the crypto market without actually having to invest in crypto. Talking about cryptocurrencies, here you have Elon Musk talking about Dogecoin, saying we're going to the moon very soon. 420,000 people love this comment. Elon Musk can move stocks with high capitalizations by himself just by a comment. And now you have him saying that basically he agrees with Dogecoin. So, of course, if this guy who's a brilliant mind agrees with it, you have 420,000 followers here. And how many of these followers do you think actually jumped on there? I would say a lot. So here you have the price chart from April 12th to April 19th for Dogecoin. And you can see that it skyrocketed all the way to 40 cents on April 17th. One of the reasons that it did this on a weekend is because the stock market is closed on these days. So I can imagine that a lot of people that weren't in the crypto market yet and made a lot of gains in the stock market had to sell their shares in the stock market, take gains in order for them to participate in this coin. As you can see, there's only so much money to go around, and a lot of people are trying to sell their stocks in order to get into some of these other things. Some people are selling stocks because they made a lot of gains and they're selling it to buy a house. Some people are selling their stocks because they want to get into a cryptocurrency. So it's not all because of fear. Reason number 2 It's tax season. For many people, this is going to be the first time that they ever have to pay capital gains, whether it be short-term capital gains or long-term capital gains. With these brokerages advertising commission-free trading, it was like a no-brainer to jump in there, especially when one person made money and then they saw their other friends make money. But what's happening now is that the tax man is calling. And unfortunately, a lot of people don't have the money in a savings account or on the sidelines that is designated strictly for taxes. So what is happening is that a lot of people have to sell their stocks, even though they don't want to, and they want to be a long-term investor. In order to fulfill their obligation of paying taxes, they have to sell. This is happening a lot more frequently than you would think. Here you have an article from the Wall Street Journal. New investors discover tax pitfalls. With 2020 tax bills coming due, a wave of new retail traders are waking up to the fact that it can be difficult and often impossible to make tax minimizing moves on a new brokerage platform such as Robinhood, Webull, SoFi, Uphold, and Public.com. Some don't allow trading within tax-favored retirement accounts such as IRAs. Traders can also find it hard to track their wash sale that reduces tax benefits if they buy a stock within 30 days of selling the same stock at a loss. The option of selling specific lots is readily available at traditional brokerage firms, but Webull, SoFi, Public, and Uphold don't allow it, and Robinhood makes it difficult. This fact shocks professional money managers. So an example of what they're talking about here is, let's say in March of 2020, I bought 100 shares of Apple. And then in June of 2020, I bought another 100 shares of Apple. Now, March 2021, it's been a year. So now I qualify for long-term capital gains for that first block that I bought of 100 shares in March of last year. The problem is when I go to sell in one of these brokerages, it's going to sell whatever 100 shares they want to sell. They don't split it up into the 100 from March and then the 100 from June. So instead of just paying my long-term capital gains, which is a lower tax rate, I'm going to have to pay the short-term capital gains from the 100 shares that I bought in June, which can really hurt a lot of investors. Now, there are some brokerages out there that do allow you to sell the block from March and the block from June separately. One of these brokerages is eToro, which will be going public soon via SPAC. If you've never heard of eToro, they sell cryptocurrency and they sell stocks. And again, they do allow you to sell specific blocks of crypto or stocks, which is good when you do want to preserve those short-term and long-term capital gains. If you're interested in eToro, I have a link in the description below. If you use that link, you get $50 for signing up. At the end of this video, I'll leave a link to a video that I made on eToro and their upcoming SPAC merger. I'll also leave a link to another video where I talk about taxes in relationship to investing. Here's why this issue matters. Tax laws allow investors with taxable accounts to use the losses they incur when they sell a stock that's dropped to offset the taxes on gains from the sales of stocks that have climbed. The losses can also offset up to $3,000 of other income such as wages each year. Unused losses carry forward for use against future gains and other income. What this means is that the IRS allows you to file up to $3,000 in realized loss. What a realized loss is that you actually sold for a loss. If you file those $3,000, it will count as a deduction on your taxes, which will help you out a lot. Some investors use this during something called a wash sale, where they sell on purpose in order to minimize their tax obligation. Now, if you have more than $3,000 in realized losses, the extra, you can move it over to the following year. So that's great. Now that I've done research on taxes, I wish I could sell the shares I choose, not a share selected by the sell button, says Ashton Corson. Age 26, a construction worker and manager from Portland, Oregon, with about $17,200 in an account at Robinhood. He's not using much, in part for tax reasons. So as you can see, taxes are playing a big factor into why the market is down. Reason number 3 is margin calls. During the pandemic last year, a lot of people were stuck at home and they weren't working. But again, like we talked about, they were either making money investing or they saw other people making money investing, and they didn't physically have a lot of money to start, but they thought to themselves, why don't I use margin, which is basically a loan, invest that, make profit on that, pay the loan back, and then I'll have money that I made out of thin air. Unfortunately, this strategy doesn't work when the market is going down or the stocks that you're invested in is going down. Traders who are issued a margin call are in debt to their broker. The broker will require you to repay the debt and can force you to sell other assets to come up with the debt. A lot of the definitions that I found for margin call on the interwebs sort of give the impression that the brokerages kind of ask you for the money back or ask you to pay back or put more money in your account. In reality, that's not how it works. Once your account hits a certain threshold, even if you're not in the negative, the brokerage will sell everything you have in order to make their money back. So let's say you start with $100 and you decide to take out another $100 of margin. So now you have $200. $100 that's yours and $100 that you're borrowing. Let's say your stock goes up to 300 and you decide not to sell. During these months, all you've lost is the percentage that the brokerage is charging you for that margin, which could be 3%, 7%. It all depends on the brokerage. But now, let's say the stock starts dropping. It hits 200. You're still good. Now, let's say you drop under 200. Now you're in the territory where you're close to being margin called. The brokerages will give you a certain percentage that you can't go under. And let's say that quantity ends up being $120. Your account drops all the way to $120. At this point, the brokerage is going to force sell at least $100 worth of your account in order to get their $100 back, maybe even some interest. And at this point, you'll probably have like $15, $18 left in your account. This happened recently on a big scale with a company called Archegos. Before Friday, March 26th, few people may have heard of Archegos Capital Management, an investment vehicle run by Bill Huang, a former hedge fund trader with a checkered past. But it has emerged as the entity behind a fire sale of at least $20 billion worth of equities, which roiled stock markets on an otherwise unremarkable Friday and has left at least two global banks, Credit Suisse and Nomura, facing multi-billion-dollar losses. Financial regulators in America and Europe will have a say before the affair has run its course. So what happened here is exactly what we talked about, just on a humongous scale. Bill Huang here borrowed money from a lot of different banks and invested it in speculative stocks. So now, since a lot of stocks have been getting hit, his account got hit and he fell below that threshold, which had to force sell billions of dollars worth of stock, which took a lot of money out of the stock market. So this here is just an example of two ways to cover a margin call. The first one is to sell your stocks in order to lower the amount of margin. The second one is increasing the percentage of equity by decreasing the margin and adding equity. So all this means is you put more money into your account. The smart thing to do would be not invest that money, because once that money you invest, if that goes down, now you're even closer to a margin call. I think this right here is a great image to show, because a lot of people don't understand this. They think that if their account goes down by 10%, all they need to do is make 10% back in order to be good. It doesn't work that way. If your percentage drops by 50%, you have to make your money double. The money left in your account has to double in order for you to break even. So for example, you invest $100 and your account drops 50%. It goes to $50. Now that $50 doesn't go up 50%, because that would be $75. That $50 has to double, which equals 100%, in order to go back to the $100 that you were. And a lot of people don't realize how hard it is to have something double. It doesn't happen as frequently in a regular market cycle as it did during this last year. Reason number 4 is all this that I've talked about has scared away a lot of investors. So this is when the fear does come to play. Now, a lot of these people who've gotten burned and gotten margin calls on them, they don't want to play anymore. They don't want to be in the stock market no more, because instead of winning, they lost, and it scares those people away. So now that's even less money that you have in there. This is the reason that volumes in the stock market are drastically lower than they were between April and December of 2020. This ties right into reason number 5, which is money on the sidelines. This is money of people who are just waiting for the market to drop and don't want to get in too early. They don't want to do something that is called catching a falling knife, which is thinking that a stock is low, putting money on that stock, and just watching it keep dropping down. Since the start of the year, institutional cash balances have surged 9% to $3 trillion, according to Lee. Institutional investors are even more cautious now, Lee said in a note on Sunday. They're talking about Tom Lee from FrontStrat. But the biggest driver of imminent stock market gains will likely be the significant rise in cash on the sidelines since the start of the year, according to Lee. Institutional investors are even more cautious now, Lee said, pointing to a 9% increase in institutional cash balances since the start of the year. Institutions have raised $241 billion in cash and currently sit on a $3 trillion cash pile. And this money is not going into the stocks that you like. Reason number 6 is mean reversion, or stocks reverting back to the mean. What this means, no pun intended, is that stocks that have dropped drastically for no fundamental reason or technical reason tend to go back to their average price, which is fair market value. Or stocks that go to the moon tend to come back down. Mean reversion is a financial term for the assumption that a stock price will tend to move to the average price over time. When the current market price is above the average price, the market price is expected to fall. In other words, deviations from the average price are expected to revert back to the average. This is because outperformance tends to persist in the intermediate term and reverse in the longer term. At a certain point, at around the 3 to 5 year point, buying the market's biggest losers actually outperforms the period's winners. Now, keep in mind that that definition there is from an average market cycle. This is not a normal market cycle because of how fast the market dropped last year and how fast it corrected and broke to record highs. So because it went back up faster than normal, you're going to see it fall back down faster than normal. The 7th and final reason is something that's probably evident to you, and I won't waste a lot of your time with it, but it's the rotation from growth to value. Companies like McDonald's, Coca-Cola, Procter & Gamble, all the boring companies out there have actually outperformed since January to now. They're outperforming the high flyers from last year, such as Facebook and Amazon and Google and Netflix. And this is something that's healthy, something that happens in a normal market cycle. When growth gets too overheated and too overbought, you'll see a rotation of value because at that point, value is really attractive. That's when you'll see your industrials, your financials outperform the rest of the market. And that's exactly what's been happening. I personally think that the financials will outperform and surprise this year. In June, the Fed chair, Jerome Powell, he's going to announce the results from the stress test that was given to the banks all throughout this year. Once those results come out and they'll see how good the banks performed on the stress test, I have no doubt that the banks are going to fly. So what am I doing? I'm staying the course. You should stay the course as well. Remember why you invested in the companies that you invested in to begin with. Have any of those things changed? Have any of the fundamental reasons that you invested in these companies changed? If the answer is no, then continue to buy. Study the charts and use those as technical indicators to buy. Also, don't be afraid to sell. It's healthy to take profit, especially when stocks get overbought. If your stock goes up by 20%, take 20% off the table, or whatever strategy works for you. But I want to know what you guys think. Do you agree with these 7 reasons? Do you have some other reasons that you think we should be considering? Let us know in the comments below. As always, invest in me and press that like button, invest in yourself, and smash that subscribe button. It costs you nothing. If you want to watch the video I made on eToro, then click on this link right here. Or you may find it beneficial to watch the video that I made on taxes up here. Until next time.